Good afternoon. Thank you all for joining me for the second SURF webinar of 2022. In today's session, we will be discussing risk. So on the agenda today, I will touch on what risk is, how to think about risk in the context of investment portfolios. Then we'll look at the investment strategy of the fund, and specifically talking to how risk was a consideration with regards to the design of the investment strategy of the Sygnia Umbrella Retirement Fund. Then I will show you the performance. As you know, every month we do cover the performance analysis as well as the surveys where we see how the portfolios stack up to others in the market. And then we'll touch on some of the SURF portfolios risk metrics. So now that we would have covered risk, what risk is, how to interpret it, we'll have a look at some of the risk metrics of the portfolios. And then lastly, we'll look at the portfolio positioning. So as always, please feel free to type in any questions that you may have as I go through the webinar, or you're welcome to wait until the end. If you don't have any questions, but you think of something afterwards, you're welcome to email us and I will gladly get back to you via email. So talking about risk, specifically in the context of investments, in finance terms really. So risk is defined as the chance that an outcome or an investment's actual gain differ from what was expected. It also includes the possibility of losing some or all of your investments. So for example, if you invested 10 Rand and you expected that 10 Rand to grow to 12, risk really is having a different outcome. And the possibility that your 10 Rand not only does not grow to 12 Rand, but potentially you lose some or all of that money. And every investor has a unique risk profile. Partly it's determined by personality. So, you know, if two people have exactly the same circumstances, exactly the same financial situation, exactly the same expenses, they earn, everything is exactly the same. Just from a personality perspective, one might be just a bit more willing to take risk than others. Some people are more of a risk averse than others, but more so than personality, it's typically people's circumstances, their age, and other factors that play a role with regards to how much risk you are able and willing to take. And really this relationship between risk and return is fundamental. So essentially what that relationship is that the greater amount of risk I take, the more I want to be rewarded for that risk. So you will often hear me saying in these webinars, and we often talk about risk, saying, you know, the higher the risk, the higher the return over the longer term. So as an example, if you compare a US Treasury bond to a corporate bond, you would expect to be compensated more for lending your money to a corporate than lending your money to the US government. You don't expect the US government to default. You don't expect the US government to go bankrupt. So lending them money is almost seen as risk-free. The government will pay you back. But lending to a corporate, we know with companies they can, you know, fail, they can go bankrupt. So lending to a corporate, although it's still not that risky, it is definitely riskier than lending to the US government. So between those two investments, you would expect to be compensated more to lend to a corporate than what you would be to lend to the US government. And in finance, if you look at our fund fact sheets, and when we speak about risk, when we show you any sort of risk metrics, the most popular risk metric that we use in investment management is standard deviation. So it really is the measure of volatility of asset prices. So it measures really the dispersion of asset prices around the mean value being the average value. So a high standard deviation means that there's more volatility, and a lower standard deviation means that there's less volatility. So the higher the standard deviation of a portfolio, the riskier it is. So if you're comparing portfolio A with portfolio B, if portfolio A has a higher standard deviation, then you can assume that it is riskier, and the returns would have a higher dispersion and higher volatility around the mean. Another very popular measure used is the Sharpe ratio. So if you look at this formula that I have included there in green, how the Sharpe ratio is calculated is you take the return of the portfolio in question, you minus the risk-free rate. Risk-free rate can be US Treasuries or any other risk-free type of investment, and you divide it by the standard deviation of the portfolio. So what you're trying to achieve here, or how to interpret the Sharpe ratio, is really you want to see how much extra return you are getting for that level of risk. for the extra risk that you're taking on top of the risk-free rate. So it can be interpreted as whether, the Sharpe ratio can tell us whether investing or the return of a portfolio is due to wise investing or due to the assumption of excess risk. So the greater the portfolio's Sharpe ratio, the better its risk-adjusted return. So the better you have been rewarded for that extra risk that was taken. So standard deviation and Sharpe ratio are probably the most popular risk metrics. There are many others. There's many opinions as to what should be used and what's appropriate, but these are some of the very well accepted ones. And if we look at the Alexander Forbes surveys, for example, which we will look at a little bit later, standard deviation is the one that's used as a risk metric in that risk return scatter plot. And I will go through that a little bit later as well. Now, some of the, two of the most important things that actually determine an individual's risk tolerance are probably time horizon and liquidity. So the longer that you have before you will need the money from the investment, the more likely that you are to be able to take on some risk. And liquidity, how soon do you need the money? Do you need to be invested in something that if you need to withdraw it tomorrow, it's easily accessible, or can it be an investment that can be locked in for a certain amount of time, and you won't actually require access to the money? So those two things really are key factors that influence risk management. So if you do need the money to be very easily accessible, then you're less likely to take on a riskier investment, and you're more likely to rather invest in something less risky, such as some type of a money market investment. And then time horizon, especially in the retirement fund context, we often talk about time horizon. We know younger members that are starting out their careers in their 20s, only going to retire in their 60s. They've got 40 years. So in those 40 years, a lot can happen. Yes, big market events happen, financial crisis, COVID crisis. Now we're seeing a war playing out. And all of these things do affect markets, but we know that markets do go up and down, markets react to sentiment, but the longer your time horizons, the more flexibility that you have to actually go through these market cycles. So younger members, we know that we're not going to need the money for the next 30 to 40 years. We can take on a higher amount of risk in the portfolio. So probably the two most important factors, although there are others such as personality even that I mentioned a little bit earlier on. And this risk and return trade-off that I spoke about a little bit earlier, that really is the fundamental to, the relationship, of investments. It's really, the higher the risk, the higher the return, and the lower the risk, the lower the return over the long term. So if you look at the little diagram that I have included, in a typical risk return scatter plot, we would measure risk on the horizontal axis, and the further right you look, the more risk a portfolio is taking on. And then return would be on the vertical axis. So if you look on the left-hand side, you'll see the lower the risk, the lower the return, and the higher the risk, the higher the potential return. That is why it is advisable for younger members in retirement funds to be invested in higher risk portfolios, to take advantage of the fact that they do have a long-term time horizon, and to be able to get these, much higher potential returns over the long term. But every investor must consider his or her own circumstances and how much risk they're actually willing to take. And some of the other factors that maybe I didn't mention earlier, I've mentioned age, but income is also a factor. So for somebody that is saving their last 500 Rand towards retirement, it's really important that that 500 Rand is protected and grows quite nicely. For another person that has, paid all their expenses, paid their bills, saved in various vehicles, maybe that extra 500 Rand is less important, and they're willing to invest in something riskier with a high probability that they lose it. But even if they do lose it, everything of theirs is paid and in order. So income definitely plays a factor. Your investment goals, what are you trying to achieve with this money? How much extra do you have outside of the retirement fund context, for example? we only see, members' fund benefits, but a lot of members may actually have a lot of investments outside of that. Your liquidity needs, as I mentioned earlier, how soon will you require access to the money, time horizon, which is very much linked to age as well, and then the personality that I spoke about. Some people simply can stomach a lot more risk and volatility than others. So there's many different types of risk. So you get business risk, and business risk is the risk that you're exposed to a company that may fail. You get credit or default risk, and this is the risk that you enter into a transaction with somebody that's not able to meet their obligation. You get country risk, and that's the risk of uncertainty that comes with investing in a certain country. You get foreign exchange risk, and that's the risk that currency fluctuations actually affect the outcome of your investment. So potentially it is a very good investment, but then that currency weakens, so it's not worth what you expected it to be. Political risk, the risk that you experience losses by investing in a certain country or region due to political noise. Counterparty risk is that the other counterparty that you're transacting with doesn't meet their obligations and potentially pay you, so that's a risk. And then liquidity risk, the risk that when you actually do require your money, it's not liquid and just simply not available for you to withdraw at a time that you do need it. So there's many different types of risk. And, in broad terms, the risk that we speak of when we're speaking about the investment portfolios is really the risk of capital loss and really that volatility, how volatile a certain portfolio is relative to another. Now, there are ways to reduce risk, and not the only way. There's many ways to reduce risk, and it's not simply that we need to avoid it. Just because something is risky, it shouldn't simply be avoided. Because of that risk-return relationship, we know that we need to take on some risk in order to be rewarded for that risk taken, and that reward would be the much higher returns over the long term. And in a retirement fund context, we are after inflation-beating returns. And these are, this is what we need in order to be able to retire comfortably and have enough money to look after ourselves in retirement. So some of the ways to reduce risk is, of course, the number one is diversification. So by not having all of your eggs in one basket, by having a very good diversified portfolio, there's times where certain asset classes perform worse than others. A lot of, most broad asset classes are uncorrelated, meaning that they don't behave in exactly the same manner in every market environment. So that's really positive. So when one is doing really well, some others may not be doing so well, but when the tides turn, then some of your safer asset classes might do well and risky asset classes not so well. So to have a very well diversified portfolio, which is exactly what Regulation 28 is actually there for, forcing us to invest not only just in equities, but to also have some investments in bonds, to have some investments in money market, to consider other asset classes such as infrastructure, such as private equity. So having all of these different asset classes blended all together in one portfolio creates a lot of diversification, and that diversification benefit in itself reduces risk. To do adequate due diligence before you invest, so know what you're investing in. So us as money managers, we cannot blindly invest into one asset manager or into a certain index without fully understanding what we are investing in and doing the necessary due diligence. And then, of course, ongoing monitoring. It doesn't mean that once you create an investment strategy once, you should close your eyes and never look at it again. Of course, for members, you have to have that long-term mindset and trust that the investment manager is continuously monitoring it. But even as individuals, management committees as well as members should have that continuous monitoring to make sure that the investment strategies is actually achieving what it's meant to achieve. So a number of ways to reduce risk, but the number one is diversification. So now I'll cover the default investment strategy, but specifically trying to link it back to how thinking about risk definitely played into the design of this investment strategy. So the investment strategy of the Sygnia Umbrella Retirement Fund is a life stage model that's implemented by the Board of Trustees. And then every employer chooses one of 3 investment philosophies that underpin the life stage model. The default is a life stage model because we understand that members that have a different time horizons can take on a different amount of risk and therefore should have a different portfolio construct. We also understand that not every member, even if they're the same age, not every 30-year-old has the same circumstances as the 30-year-old next to him or her. So members have their own personal circumstances and their own risk appetites, and for that reason, the life stage model, as much as it will work for more than 90% of members, there are certain situations where members would need to opt out of the model and choose their own investment strategies. For that reason, member investment choice is allowed. There's no limitation on the frequency of switching or the time that members may switch their portfolios, and there's no cost to switching. And there's a number of different portfolios that members can choose from. So the life stage model follows a glide path whereby younger members are invested in higher risk portfolios, because we know that with a longer time horizon, they can stomach more volatility, they can actually take on more risk. And then your older members closer to retirement are in a more conservative portfolio with less exposure to risky assets, as their time horizon is much shorter and they need to be exposed to less volatility. So the transition happens from 6 years before retirement to 1 year before retirement, and it goes from the 70 portfolio right down to the 40 portfolio. The numbers in the names of the portfolio, an indication of the equity allocation. So a member would move from a portfolio that has roughly 70% allocated to equities right down to a portfolio 1 year before retirement where only 40% of the portfolio is invested in equities, meaning that the other 60 or so percent is invested in safer types of asset classes such as bonds and cash. Then each employer would choose between the Skeleton, Signature, and Synergy range. The difference between these 3 ranges is the Skeleton range is the low-cost passive option, the Signature range is a blend between active and passive management, and the Synergy range is mostly active. The offshore portion of all of these portfolios is 100% low-cost and passive. The specialist approach is what's followed in the Skeleton and Signature range. Sygnia controls the asset allocation. The asset allocation is decided up front, and then once we've decided what percentage should be invested in equities, we then go and find the best equity managers or equity strategies or equity indices to track. Whereas in the Synergy range, the split is done upfront, so a number of asset managers get a certain portion of the portfolio, and then that decision-making on the asset allocation, how they wish to split between equity, bonds, property, cash, is left up to the asset managers. So that's the difference from a portfolio construction perspective between the specialist and the balanced, with Skeleton and Signature following the specialist approach and the Synergy range following the balanced approach. Now, here is an example of a risk and return scatter plot, similar to what I showed you a little bit earlier, where we look at risk on the horizontal axis and return on the vertical axis. So if you look at all the portfolios that are available for members in the Sygnia Umbrella Retirement Fund, they can all be plotted somewhere on the risk return metric. Starting on the right-hand side, you've got your higher risk portfolios. So these are the portfolios that members would default into if they were following the life stage model. So all members can opt into these portfolios, even if the life stage model says that you only have a few years to retirement, let's say 2 years to retirement, you can opt out and go into the 70 portfolio again. We don't know what a member's circumstances are, so a member can do that. They potentially want to work for longer or want to buy into a certain investment product where it makes sense for them to be invested in the market right up until retirement. So you've got your higher risk portfolios. Those are the 70 portfolios. They're further to the right and a little bit up because, yes, they take on more risk. That's why they're further to the right. But over the long term, we do expect a higher return from them. And then you've got your single manager portfolios there. They also invest, largely in local and global equities. So from a risk perspective, they're higher on the risk side, but they, provide you with those good inflation-beating returns over the longer term. In the middle, a little bit less risk, a little bit less return that's expected. You have your 60 and 50 portfolios. These are seen as your medium risk portfolios. So take on less risk. So there's less risk of capital loss. You can expect less negative returns from these portfolios when markets are not doing so well. But over the longer term, you should also expect less positive return or less growth from these portfolios. Then your low risk portfolio is really suitable for members that cannot stomach the volatility, ones that are very close to retirement, ones that are planning to, take out their savings out of the fund, quite soon. These are your 40 portfolios, lower risk, but also lower return. And then the ultra low risk is your money market portfolio. So by investing in money markets, yes, the risk of capital loss is, practically not there, but you also don't expect to, beat inflation plus targets over the longer term. So it's, similar to leaving your money in the bank. You don't expect it to multiply tenfold, if you're simply just earning interest. So very low risk, but you don't expect much in terms of a return over the longer term. So it really does make sense for members with a long time horizon to stick to more, your higher risk type of portfolios. So now let's have a look at how these have performed to the end of January, which is the latest data that we have. We can see that the 70 portfolios, specifically focusing on the 1 and 5 year numbers. So in a retirement fund context, it is always good to focus on the longer term numbers. We can see, really good double-digit returns from the 70 portfolios. We can see that the 70 portfolios have done much better than the 60, 50, and 40 portfolios, which is exactly what you expect to see. So you've taken on more risk in these portfolios, but you have been rewarded over the longer term. So we know the higher the risk, the higher the return. So members that have been invested in these portfolios have definitely been rewarded for the higher risk taken. The 60 portfolios also doing very nicely. The 50 and 40 portfolios also giving us nice double-digit returns over the 1 year period and really good returns over the 5 years as well. Across these longer-term numbers, these portfolios are comfortably ahead of their benchmarks and comfortably ahead of inflation. So all doing very, very nicely over the long term. Now, we do invest in markets, and it's important to analyze the market performance before we, analyze the performance of the portfolios. So what I'm showing you right now is the performance of the markets as at the end of January across various periods. Always good to focus on the longer term. And a few things that I want to highlight are, firstly, there's quite a difference over the 1 year number specifically between the Swix index and the capped Swix index. Now, the difference between the Swix and the capped Swix is that the capped Swix caps the percentage of certain companies to a maximum. So it used to cap the Naspers exposure in the capped Swix to 10%. Post corporate action that took place in August of 2021, where Prosus bought a whole bunch of Naspers shares. Prosus essentially became bigger than Naspers in the index, and the JSE decided to cap Prosus at 6% in the capped Swix and Naspers at 6% in the capped Swix, whereas they are not capped in the Swix. So essentially, you are less exposed to Naspers and Prosus in the capped Swix than what you are in the Swix. Now, being exposed to Naspers and Prosus is not necessarily or not a bad thing. It essentially gives you exposure to, Tencent in China, which is a great tech company. However, last year there was quite a bit of negativity in China around tech stocks. There was regulations put forward limiting the amount of hours that miners can spend on gaming and all sorts of other regulations that negatively affected tech stocks over the shorter term. From a valuation perspective, every asset manager is of the opinion that these stocks are very, very attractive. And it was just, really an overreaction to the economy in China plus these regulations. So because you were less exposed to that in the capped SWIX than what you were in the SWIX, the capped SWIX returned a better return. If you cast your eye to the 3 and 5 year figures, you can see, and even the 10 years, you can see that over the longer term, it has been more beneficial to be in the SWIX than in the capped SWIX. And then looking at January, you can see that gap closing as well. So the reason why I'm pointing it out is in our portfolio, so in the skeleton range as well as the signature range, there is a portion that tracks the SWIX index. So we're specifically exposed to the SWIX, and we are still of the opinion that the SWIX makes more sense. It has a higher offshore exposure, lower turnover, and lower turnover means that we rack up less transaction costs, which ultimately affect the total investment charges of the portfolio. So that's the first thing I want to point out is, yes, over the 1 year, there is a bit of a discrepancy between the capped SWIX and the SWIX when you're investing in South African equities. So the choice of index did matter. But we still have the view that the SWIX makes more sense for our portfolios. The second thing I want to point out is the return of property. So property over the 1 year, coming off quite a low base, gave us 37.4%. So the best performing asset class, if you look down the 1 year column, for this period from February 2021 to the end of January 2022. However, look over 3 years, look at the number over 5 years, it was a negative returning asset class. So over the longer term, it would have been beneficial to avoid property, which we have done in our portfolios, but specifically over this 1 year period, portfolios that had property versus portfolio that didn't have property would have had quite a difference in return. So the Sygnia portfolios, the Sygnia Umbrella Retirement Fund portfolios did not have any direct exposure to property, specifically referring to the Skeleton and the Signature range. And relative to some competitors that did, then we would have underperformed those portfolios. As much as the portfolios beat inflation and beat their own benchmark, I'm talking about the relative basis. And then looking at property again, just for the month of January, minus 2.9%, yes, very short term, but we can see that it's going kind of negative again. And then the last thing I want to point out is how global markets have performed. So looking at global developed markets, which is largely your US, your Eurozone, Japan, we can see that over the last year, 19.8% in Rand terms, whereas emerging markets, China being the largest percentage of the emerging markets index, gave us minus 4.7. We do have exposure to both emerging markets as well as developed market. Of course, a lot more developed markets, although relative to benchmark, we are slightly overweight emerging markets. And we do continue, despite this 1 year, negative return of emerging markets from a valuation perspective, they are looking very attractive. So we continue to invest in emerging markets, and we do believe that it is attractive for the long term. So how have these portfolios done over the long term? Well, looking at the 70 portfolios where the bulk of the Sygnia Umbrella Retirement Fund members are invested, we can see that over the long term, these portfolios have done really nicely. What this chart measures is how 100 Rand invested once into each of these would have grown over the period since May 2012. So over the last 10 years. So looking at the 3 red lines, we can clearly see that whether you invested in Signature 70, Skeleton, or Synergy 70, that 100 Rand would have grown quite nicely, not without volatility. So we know that these 70 portfolios have roughly 70% allocated to equity, so they do take on risk. And we know that when we're investing in riskier portfolios, we can't expect a smooth return. We can expect volatility of returns, but important is that these are growing. And compared to the black line, we can clearly see that all 3 of these portfolios have comfortably outperformed the black line. And the black line is the median performance of the managers listed at the bottom, which are some of your largest and most established, retirement fund managers. So portfolios all doing quite nicely. Now let's look at the peer comparison of the surveys as of 31 January. So over the last 6 months, we can see that all 3 of these portfolio ranges, when looking at the low equity multi-manager survey, are at the top of the ranking tables. Over the 1 year, we can see that Synergy and Signature are, just, third and fourth in line there, with the Skeleton 40 a little bit further down. Over 3 years, really good performance, at the top of the ranking tables against peers, and over 5, 7, and 10 years, really doing very, very nicely against competitors. So these surveys compare like-for-like portfolios, and what we just looked at was the low equity multi-manager survey, meaning that all of these portfolios are low equity in nature. Looking at the low to medium equity multi-manager survey, this is where the 50 fund fits in. Again, over the 6 months, we can see, the portfolios in the top half, with the Synergy 50 fund being the best performing. However, over the 1 year, we are further down the bottom. And this really comes down to the story of SWIX versus capped SWIX and the lack of property exposure. So I showed you that property was the best performing asset class when you're specifically looking at that 1 year period. If you did not have property in your portfolio and you're comparing yourselves against other portfolios that did, then you would have likely underperformed those portfolios. And then if you were investing in the SWIX and others were investing in the capped SWIX, then that's another reason for the underperformance. But 1 year, very short term in a retirement fund context. So focusing on the longer term numbers again, we can see over 3 years, the Signature 50 fund, second best performer with the Skeleton 50, the third best performer, and the Synergy 50 somewhere halfway through the rankings. And then importantly, again, over the longer term, really good consistent performance with really top performance over the long term, with the Signature 50 fund being the best performing in this category over the 10 years. The medium equity survey is where the 60 fund slots in. And we can see that over the 6 months, the Synergy 60 was the best performing portfolio. Over 1 year, similar story with, the lack of property and the SWIX versus capped SWIX. We can see that the portfolios are further down the bottom, but over 3 years, top of the ranking tables again, and over 5, 7, and 10 years, which is really that good consistency in long-term performance that should be the focus of retirement funds. And then the 70 portfolios. This is the high equity multi-manager surveys. In the 70 portfolios are probably the ones we should be spending the most time, analyzing, comparing, really trying to understand where returns came from. As I mentioned, if you look at, where the assets of SURF are invested, where members' assets are invested, the bulk of the assets are in the 70 portfolios. Most members do default into the life stage model, have more than 6 years before they retire, so they slot into the 70 portfolios, and they will be spending the majority of their working lives being invested in these portfolios. So over the 6 months, we can see Synergy, second best performer, Signature a little bit below that, and Skeleton, still in the top half of best performance. Over the 1 year, however, we see Synergy right up there in the top half of good performers, Signature further down, and Skeleton the worst performing on a 1 year basis, which is very short term, especially for a 70 portfolio where a young member is invested. And this really is, in these more aggressive portfolio, the allocation that you would have had to local equities and local properties is even more pronounced because it's bigger. So that gap of whether you had property or didn't, and whether you followed the SWIX or the capped SWIX, has a bigger impact in the 70 portfolios than what it does in the 40 and 50 portfolios, for example. Over the 3 years, we can see, firstly, that the difference has become a lot smaller. So you're not talking, 10%, for example, differences between the best and worst performing on the survey, but that gap is closing. So although the Synergy and Signature are third and fourth in line, we can see that the difference between their performance and the best performer is only 0.3%. This is also gross fees, so fees have not yet been deducted, meaning that if you take a Skeleton portfolio, for example, that's very low cost, it's passive, there's no active managers, there's no performance fees or anything expensive in there. On a net fee basis, Skeleton would actually rank a lot higher than some of these other portfolios that could be a lot more expensive if they invest in hedge funds. If you have a lot of expensive asset managers, on a net fee basis, the performance would look quite different as well. And then especially in the 70 portfolios, very, very important that we're focusing on the longer term. So over 5 years, Synergy best performing, followed by Signature, and Skeleton not too far behind there, a couple of basis points. Over 7 years, a similar story, and over 10 years, we can see really top performance from Signature and Skeleton. We don't have, long enough track record to include Synergy in the longer term numbers. So we can see that over the 10 years, these are annualized returns. So anything longer than a year has been annualized, meaning that the way to interpret this 12.6 number, for example, for Signature 70 over the 10 years, had you been invested in this portfolio for the last 10 years, your return would have been 12.6 per year for the last 10 years. So really good, solid performance over the long term. Having a look at how these stack up to single manager portfolios, we can see over the 6 months, a couple of single managers have outperformed, quite a few have underperformed, and these, very well diversified, multi-managed type of portfolios are sitting somewhere in the middle. Likewise, over the 1 year, some of them have done better, some have done worse. Over 3 years, interestingly enough, it's only really Coronation that has managed to beat the performance of these portfolios. Over 5 and 7 years, the Synergy Fund is the best performing, with Coronation and 91 being some of the best performing managers. Both of them are actually in Synergy as well as in Signature. And over the 10 years, none of the single managers have managed to outperform the Signature 70 portfolio, showing you that good consistency of a very well diversified portfolio that is able to deliver, inflation-beating returns through the market cycles. And then in the surveys, not only return is considered, but risk is a massive consideration as well. So again, showing you a risk-return scatter plot, just like the others that we looked at earlier in the presentation, with your risk in the horizontal axis and return on the vertical axis. For every level of risk, you basically want the top performing portfolio. And if we look at where Signature 70, Skeleton 70, and Synergy 70 plot, we can see that for the level of risk that they take, there are, some of the best performing portfolios. The 40 portfolios are further to the left. And again, for the level of risk that they take relative to competitors, they've done really, really nicely. The portfolios that are furthest to the right are some of the portfolios that have taken on even more risk than your portfolios, but looking at their corresponding return over the longer term, they simply have not delivered. So they've not been rewarded for that risk that they have taken. Earlier on, I spoke about various risk metrics, and I mentioned how standard deviation and the Sharpe ratio are probably the most important ones, or the most commonly used ones in the context of investment management. So just a reminder again, with standard deviation, the higher the standard deviation of the portfolio, the more riskier portfolio is. But we know that it's not necessarily a bad thing, because we know that the higher the risk, the higher the return, theoretically over the long term. And with the Sharpe ratio is really measuring whether the portfolio is giving you what that excess risk is over the risk-free rate, relative to the risk-free asset. So it's really the higher the Sharpe ratio, the better as well. So for both of them, the higher it is the riskier, but in the Sharpe ratio, the higher the Sharpe ratio, the better the risk-adjusted return. So that really shows you how much excess return you are given for the volatility of the asset, essentially. So again, what we're going to look at is the portfolios in the Sygnia Umbrella Retirement Fund. So not to make it too confusing and to compare too many portfolios, I wanted to really compare basically the two extremes, your 70 portfolios to the 40 portfolios. So your 70 portfolios have about 70% invested in equities, and 40 portfolios at 40% invested in equities. And these are the life stage portfolios. So if we have a look at the standard deviation of the 70 portfolios, we can see that the standard deviation of these 70 portfolios is much higher than the calculated standard deviation of your 40 portfolios. So they do take on more risk. They've got more invested in equities. The volatility or the dispersion of returns is a lot higher. But when we looked at the performance, especially over 5 years, over the longer term, or even over the 10 years, we can see that you are being rewarded for that risk taken. And then the Sharpe ratio, showing us how much excess return you can get for the volatility that you take for an asset. The higher the Sharpe ratio, the better. We can see that the 70 portfolios do have higher Sharpe ratios than your 40 portfolios, which is exactly what you expected to see. And these were calculated over as long a period as possible. So we had, 9 years of solid data that we used to calculate these ratios. And then lastly, I did mention a little bit earlier on that there's a number of ways to reduce risk in a portfolio without necessarily giving up the return. So you shouldn't be reducing risk by simply avoiding it, as I mentioned, and just saying, let me just invest in money market, let me go to a low risk portfolio. But diversification is probably the most important element and a good way to diversify risk. So when we think about our portfolio positioning, we definitely think about being diversified in many different asset classes. We invest in a core satellite approach kind of way. The core of your portfolio are your traditional asset classes. And the pluses and minuses are showing you our current positioning. So we're slightly underweight SA equities, overweight South African bonds, overweight global equities, and we don't have exposure to global bonds. Then we have a number of thematic satellites. And thematic investing really is about identifying themes and sectors that we believe will provide huge growth opportunities into the future. These themes are also very often uncorrelated to your more traditional asset classes, and having asset classes that are uncorrelated to each other simply increases the diversification in your portfolios. So looking at these satellites, we've got global real estate as the one satellite. This is really your global bond alternative. Because we don't invest in global bonds, investing in global real estate makes sense as a bond alternative. We've got disruptive technologies. We've got emerging markets, specifically favoring the Asian economies and China. We've got an allocation towards healthcare, which is an important theme that we do believe makes sense for the current and future market environment. And then we've got an allocation to value as an investment style. Value as an investment style is essentially the opposite of growth. So you're really buying into companies with low price to earnings, low price to book ratios, and you expect these companies to do well in a rising interest rate environment, which is exactly what we're experiencing right now. These portfolios are well diversified across these asset classes. And we can see that the exposure to equities versus exposure to bonds and money market is quite different. If you're comparing the 40 to the 70 portfolios example, again, talking to risk. So the 70 portfolios can, tolerate more risk. So they do have higher exposure to local equities and global equities, whereas the 40 portfolios much higher exposures to bonds, income, money market that is seen as safer. So this is the strategic asset allocation of the portfolios. And then in the Signature range, we do make use of a blend between active and passive management. So you've got the Sygnia Swix tracker together with ABAX 91 and Coronation and Visio acting as your active managers. In the bond space, you also have a blend between Coronation and passive investing. In the income space, we've got Sygnia, Quanta, and Ashburton. And on the global side, we've got a lot of passive strategies and a lot of different themes that we have exposure to in the offshore portion of your portfolios. In the Skeleton range, all low-cost passive index tracking, so you don't see any of your active managers, and everything on the offshore is exactly the same. And then in the Synergy range, this is where we leave the asset allocation decision on the local side up to the asset managers. You've got a blend between Allen Gray, Coronation, 91, and Prudential. These are some of the, most qualified and most successful asset managers in South Africa. We've done our due diligence before we constructed these portfolios. And from a blending perspective, they don't think the same way. They follow different investment philosophies and processes. So it really makes sense to blend them together in the Synergy portfolio. And as we could see in the returns of the portfolio, these portfolios have done really, really nicely over the longer term as well. So that's all I have for you today. I do see there's a couple of questions. I'm more than happy to take these. And I hope that today's presentation did provide you with some good insights as to what risk is in a portfolio context, how we calculate risk, and how to think about risk, and specifically that relationship between risk and return, and understanding that we have to take on some risk if we want to be rewarded with the higher returns over the longer term. There's a question on what is driving the high returns in the listed property asset class. So we specifically saw that the high returns are over the 1 year period. So it's coming off a low base. The South African listed property was one of the worst performing asset class, back in 2020 when it was hit hard by COVID, by lockdowns, and then coming off a low base together with the fact that you have low interest rates in South Africa. Yes, we've had a hike, but we did have this 3% interest rate cut. So lower interest rates do make South Africa, or make property quite attractive. So over that 1 year period, we saw that bounce of coming off extreme lows. Also from a valuation perspective, once an asset class has been hit so hard, from a valuation perspective, it becomes attractive. So a lot of asset managers start buying up some of the shares, and then it pushes up the price. The next question is the performance on the AF surveys net of fees? No, it is gross of fees. It is quite difficult to get net of fee performance. And the reason for that is because different retirement funds pay different fees. As you can appreciate, a lot of it has to do with size. So a R1 billion pension fund would pay a much smaller percentage of assets as a R50 million pension fund. So it's difficult to compare on a net of fee basis, not knowing really what the standard fee is. That's why it's gross of fees. That's why, if you think about Skeleton, for example, being very low cost, we know that smaller fees will be deducted from Skeleton than some portfolios that have hedge funds and very expensive managers. How is the relaxation of prudential limits going to affect Sygnia portfolio construction and asset allocation? Well, firstly, we're not going to be making any, very fast decision in this regard. It's not a good time to be selling out of South African equities at the moment to buy into offshore. Overall, we really like global assets, so we will, very likely make use of that increased offshore allowance, but slowly and, with a lot of thought and carefully trading these positions, making sure that we're not really crystallizing losses on the South African side to be investing into the local side. So it will happen slowly. And we're also waiting on some clarity. The budget speech mentioned 45%. And there's questions as to whether that includes the 10% into Africa, or could you potentially invest 5% into Africa and 40% offshore? So we're still awaiting clarity from the regulators. We've made contact, and once we know exactly what those limits are, then we can start slowly and carefully increasing that offshore exposure. So the asset allocation is likely to change, but by attending these webinars, we'll always keep you up to date and show you what that asset allocation, strategic and tactical, looks like. That then answers the next question as well. Will Sygnia be increasing offshore exposure in respect of the change to Regulation 28? So most likely yes, although slowly, carefully, and we're still waiting for clarity on the regulations, and we don't feel like it's a good time to be selling out of South African equities right now. What risk is associated with an emerging economy? So definitely more risk is associated with an emerging economy relative to a developed economy. When I showed you the number, or quite a number of different risks, business risk, political risk, currency risk, those risks are higher in an emerging market economy. So we know that our exchange rate is not as solid as the US dollar or the some of the other, the euro, for example. So you expect more volatility. So if you're investing in Brazil, for example, the volatility of their exchange rate, or the Turkish lira, a lot more volatile than the US dollar, for example. So you're taking on currency risk. You're also taking country-specific risk. In emerging markets, there are more risks to the economy, more volatility. You're taking on more political risk. But you do expect to be rewarded more for these risks. That's why investing in emerging markets is attractive. That's why we do have quite a large allocation to emerging markets in your portfolios, because we do know that over the long term, you are rewarded for these risks taken. What makes emerging markets attractive is that they have not fully realized their potential. So you really are investing in economies that have a middle class that is growing, GDP that is growing. It's really the middle class that's consuming, and that's where you can expect some of the best growth to come from. What is the view of the SA government versus corporate investment? So we invest in both. We, invest quite a bit into South African bonds. We actually have overweight position in the South African government bonds. We do believe all risks are priced in, and you're getting very good, real yields from South African bonds. And then in the corporate space, in some of the income portfolios, we're also investing in corporates from a debt perspective, but of course, via indices and via your active managers, we have exposure to corporates by investing in their shares as well. So from both an equity and a bond perspective. What is Sygnia's asset management view on markets given the current Ukrainian and Russian situation? So firstly, the situation is very, very sad, from a humanitarian perspective. But in addition to that, we know that any such event affects markets negatively. But it's really key that nobody has the crystal ball to know how long it will last. Talks could happen soon where it's all over, or it could be something that drags on for another 2 years. So it's definitely going to have an effect, and it already is having an effect on the oil price. So it's affecting everybody's inflation, including our own. It will affect Eurozone inflation specifically. The markets tend to react in a risk-off type of sentiment. So even though you may be investing in a share that's in the United States, very, very far away, when you have this risk-off sentiment, people tend to take their money out of the markets, and you're seeing red and minus returns all over. But because we don't know how long this will last, it's very difficult to time the markets. So it's by no means a good idea to exit only to try and re-enter at the right time. If you look at history, and if you look at previous such periods, for example, the Cold War, the biggest winners at that time were the people that actually remained invested in the markets. So we are trading, certain asset classes at the margin, trying to take advantage of some opportunities, but broadly, we're not making any big rash decisions and any big changes to our portfolios, remembering that we are in these portfolios for the long term. They are designed for members to be invested in here so that they can retire, and they're very well diversified, which in itself, as I mentioned, does reduce risk. So overall, not making any big changes to the portfolio due to the current situation. Somebody's asking whether I will be emailing the presentation. What will happen is, now that you have attended, you will have an email in the next couple of days to thank you for your attendance, ask you if you have any additional question, and you will get a link to the recording. When you watch the recording, you'll be able to see the replay of these slides. If you don't receive that email, which you should, but we save every single webinar, not just mine, but for example, my colleague Carl is having the Markets and Economics webinar tomorrow. I often do webinars on other topics as well. Every single webinar that we do is saved on our website. So if you just Google Sygnia webinars, you should be able to find the right page, and you'll be able to watch a replay of all of them where you can also see the slides. If you're looking for a specific slide, depending on which one it is, and what exactly you're after, you're welcome to email us, and if we can, we will share a number of these slides with you. And we also have a YouTube channel, so the Sygnia YouTube channel, and you can have a look at the replay of the webinars on that YouTube channel as well. I don't see any other questions. So I want to thank you all for your attendance and your time, and see you at the next one. Thank you. Have a good week further.